The prime idea that we are trying to achieve with the help of CVP analysis is to comprehend the cost structure of the company, profit, and break-even point, so as to aid in taking better decisions to help the business. CVP is shortened as cost, volume, and profit analysis. It is a financial instrument that provides business with an insight into how alteration in the cost, level of sales, and price influence the profit. This plays a crucial role in target planning, sales strategy, as well as price decision. Prime Guard Industrial Solution is a firm that produces helmets of Guardian Shield, which play an industrial safety role. The company is within the manufacturing sector, and it believes in offering quality protective equipment in industrial use. At the moment, Prime Guard is experiencing a number of problems related to growing costs of raw materials and stiffening the competition in the market that has impacts on the profitability of the company planning. Now we move on to Part A, Prime Guard Industrial Solution SDNBHD, Statement of Profit or Loss and the Other Comprehensive Income for the year ended in 31 December 2024. This is the income statement for Prime Guard Industrial Solution for the year ending 31 December 2024. The total sales were 1,875,000 ringgit, and from these we subtract the variable costs, which include production and sales commission, totaling 1,162,500 ringgit. Next, we subtract the fixed costs like factory overhead, marketing, rental, and salaries, which add up to 4,500 ringgit. After deducting both variable and fixed costs, the company net operating income is 307 and 5,000 ringgit.
Next, I will present three key figures from the income statement for the years 2024 of Prime Guard Industrial Solutions Sdn Bhd. First, selling price per unit is 24 ringgit. Second, total variable cost of 1,162,500 ringgit, and variable cost per unit is 15 and 15 cent ringgit.
Hello, my name is Nurul Fatia Mumtaz, and I will explain this D, E, and F part. So for the variable cost, COGS to sell price ratio, the result is 0.62 or 62%. And for the total fixed cost is 405,000, and for the contribution margin per unit, the result is 9 ringgit and 50 cent.
After you get the contribution margin per unit, we just calculate the contribution margin ratio. The formula is contribution margin, which is 9.50 divided by sales price, which is 25. The result is 0.38 or 38%. Next, let's calculate the break-even point in units. The formula is all the total fixed cost of 405,000 ringgit divided by the contribution margin per unit of 9 ringgit and 50 cents. The result is 42,632 units. And this is the extra break-even point in ringgit. The formula is BEP units multiplied by sales price.
Hello, my name is Irwan Nur Asmusna binti Muhammad Rusli. My metric number is 131918. So I will continue with question I and J, which is I is break-even point BEP in amount RM, fixed cost divide contribution margin ratio. So the result is 1,065,789 ringgit and 47 cents. This means that the company must generate at least that amount in sales to cover all fixed variable costs without making loss. So the J is net income to sales ratio. Net income divide sales revenue multiply 100. The net income to sales ratio for Prime Guard Industrial Solutions Sdn Bhd in the year 2024 is 16.4%, which means the company earned 0 ringgit and 16.4 cent in profit for every 1 ringgit of sales revenue. This ratio reflects the company's overall profitability after accounting for all variable and fixed costs.
In this scenario, we need to find how many units PrimeGuard must sell in 2025 to get a 28% net income to sales ratio. Because of a 4% increase in raw material cost, the new variable cost per unit is 5 ringgit and 33 cent. The selling price stays the same at 8 ringgit and 33 cent per unit, and the fixed cost remains 405,000 ringgit. We use a formula to find the number of units needed, and the result is 606,663 units must be sold. This gives total sales around 5,053,478.79 ringgit. So, to hit your 28% profit target, PrimeGuard needs to sell over 600,000 units in 2025.
Self-reflection is this group project taught me how to apply CVP analysis in a real business situation from the Guardian Shield Helmets case, and I learned how pricing, cost, and sales volume impact profits. The most challenging part was calculating the selling price to meet the profit target, but it helped me understand the role of fixed and variable costs. We work well as a team by dividing tasks and reviewing each other's works. I believe this skill will be useful in real business discussion making, especially in planning and pricing strategy. Thank you.
And for the marketing strategy and cost efficiency improvement, we got the sales revenue. We split it out in two parts. A is variable cost production, and B is for sales commission. Uh, as well as the total variable costs, we split it out in two parts. A, we got other fixed costs reduced by 30%, and B is digital marketing doubled. As you can see, there is a total fixed cost, total cost, and we've got the net income is sales revenue. Sales revenue is minus with total cost, and the net income result is divided by sales revenue result. So we've got the so for the result, we got the net income to sales ratio is 51.12%. So this is much higher than the 28% goal, meaning that if the plan work as expected, the prime goal will achieve a very strong profitable.
In Scenario 4, we focus on a product enhancement plan. Sales volume increased by 150%, reaching 187,500 units, while the price remained at 25 ringgit per unit. However, the cost of goods sold to sales ratio rises to 57% due to higher raw material costs. Digital marketing expense increased by 30%, and sales commission stays at 12%. Fixed costs remain at 405,000 ringgit. Despite higher expense, through volume growth may significantly boost profit. Okay, let's calculate. The first step is to determine the new sales volume for 2025. Next, we calculate the new sales revenue. After that, we compute the variable cost, starting with the cost of goods sold followed by the sales commission. Then we add both variable costs together and subtract the total from the sales revenue to get the contribution margin. After that, we adjust the digital marketing cost and calculate the total fixed cost. Finally, we subtract the fixed cost from the contribution margin to find the net profit and calculate the net income to sales ratio.
So for the scenario 5, sales for restructuring, two options are evaluate to improve sales performance, such as have option A to increase sales agent commission to 18%, and under this option, the company proposed to increase the sales commission for external sales agent from 12% to 18%. The incentive is expected to boost sales volume by 50% from 75,000 to 112,500 units. Selling price per unit remain at 25 ringgit. And for the revenue is 2,812,500 ringgit for the production cost per unit. After 4% increase from 12 ringgit 50 cent is 33 ringgit. So the total production cost is 1,462,500 ringgit. And the sales commission at 18% of revenue is 506,250 ringgit. So the total variable cost is 1,968,750 ringgit. The contribution margin is 843,750 ringgit. So the fixed cost is remain unchecked at 405,000 ringgit, and the net income is 438,750 ringgit. Net income to sales ratio is 50.66%. So this option improves sales and profit compared to the current year, but the profit margin is still moderate due to the high commission rate. Okay, the option B, hire in-house sales representative. The second option involve replacing sales agents, which act full-time as house sales representative. So each employee would receive a monthly salary of 1,700 ringgit. So the total is 163,200 ringgit annually. This option also reduce the sales commission to 4% and is expected to increase sales volume by 70% from 75,000 to 127,500 units. Revenue is 3,187,500 ringgit. So the production cost per unit is 30 ringgit, and the total production cost is 1,657,500 ringgit. And sales commission 4% of revenue is 127,500 ringgit, and the total variable cost is 1,785,000 ringgit. For the contribution margin is 1,402,500 ringgit, and the fixed cost is 568,200 ringgit, and the net income is 834,300 ringgit, and the net income to sales ratio is 26.2%. So this option result is in a significantly higher net income and a much better profit margin. Okay, for the final recommendation, based on the CVP analysis, option B is the best strategy for Prime Guard, although it increase fixed cost, it result in higher net income and a stronger profit margin. The in-house sales team also offer better control and long-term efficiency. Therefore, we recommend hiring in-house sales staff as the most cost-effective and profitable approach for 2025. So that's all from me. Okay,
So after the latest scenario, we recommended that this is the final strategy, our final strategy recommendation. So we recommended that we implementing scanner 3, which mean is based on the fact that scanner 3 feels the highest net income to sales ratio at 51.1 to 0.12%. So this is indicating a superior level of profitability compared to the other option. Moreover, this scenario successfully meets the company's target profit goals, making it the most favorable and strategically sound choice among the alternatives considered.
Analyzing Guardian Shield helmets using CVP helped me understand how cost, pricing, and sales volume affect profitability. Scanners 1 to 5 were tricky, especially comparing sales team structure with shifting commission and wages. So our group divided tasks by strength and check each other works to stay consistent. So for me, these skills are practical for real business. CVP is a simple, evidence-based tool for smarter financial decisions. Thank you.
Based on CVP analysis of the case of Guardian Shield helmets, I got to know how to visualize the interconnectedness between cost, sales, and profit. It assists me in knowing the number of units a company ought to sell in order to attain a profit goal. The hardest aspect was how to calculate the number of units where the net income to sales ratio stood at 26% using the formula. Initially, it was difficult, though it got clear after practicing. My group was very compatible. We had a task split, ideas exchanged, and helped each other when one of us did not comprehend it. We verified our answers to ensure they were right. The use of CVP analysis would assist me to determine the sales targets in real business pricing or the decision to sell particular product or not. It is a good tool to arrive at improved business decision.
So through this project, I learned how to apply CVP analysis in real business situation and saw the connection between cost, sales, and profit. So the scenario 5 was the most challenging due to its comparison of two options. Our group also collaborated well with tools like website and cover slide. And the task highlight the importance of both accounting knowledge and teamwork.
So, one of the most valuable insight I gained was learning about contribution margin and break-even analysis. Understanding how even small changes like a 40% increase in variable cost can significantly affect profitability helped me see why data-driven decisions are so important in businesses, especially when dealing with external challenges like rising prices or tougher competition. The part I struggled with the most was adjusting the CVP calculation when new strategies were introduced. For example, when we had to consider increased sales commissions or a reduction in fixed costs, I found it difficult at first to make sure my calculations were accurate, but at the same time, this was also the most rewarding part of me. It showed me how often businesses must work with assumption and how important it is to be flexible and ready to compare different scenarios before deciding on the best course of action. I'm also proud of how well my group worked together. We divide tasks based on our strength, communicated openly, and supported one another when someone didn't understand something. Using tools like Google Sheet and group discussion really helped us stay organized and on the same page. I realized that teamwork and communication are just as important as technical accounting skill.
Scenario 2, the company is unable to increase unit sales beyond 75,000 units. Therefore, we calculate the new selling price per unit required to achieve the 28% net income target. So based on your calculation, the selling price must be increased to 13.767 per unit. In terms of risk and feasibility, first, 20.7% price increase may lead to a drop in customer demand due to the price sensitivity. Second, competitors may offer lower price, resulting in potential loss of market share. Third, sales agents may struggle to promote the product at a higher price point. However, this strategy is still feasible if the company one highlight the product's uniqueness, such as its smart sensor technology, thus position the brands as a premium safety solution and adds value to service like warranty, training, or customer support. In conclusion, although the strategy carries risk, it is mathematically achievable and co-success with proper planning and strong value communication.